Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in the last video we talked about two companies that are compounders, great companies, pay dividends. One of them is Dividend King, growing revenue, growing everything, financially very good companies, and we talked about the valuation at the end. So if you haven't watched that video, go and watch that video first. And we're going to talk about similar thing today, where we're going to look at two companies that are, in my opinion, absolutely amazing businesses and so on. They're very good compounders, they pay dividends, growing dividends and so on, and we want to see if they are a buy right now, a hold or sell. Now, just to talk about the portfolio very quickly, as you can see, for the 1 week we are down about £4,000. At one point last week I think we were closer to £20,000, and right now we are £15,000. This is going to continue for quite some time. The market is going to go up, it's going to go down, it's going to do what it does normally, and I'm going to continue buying, inshallah, high quality businesses, and don't worry too much about the fluctuation of prices. I'm not trying to time the market or anything like that, so inshallah that's the long-term plan. And now, as you can see here, the year to date for the S&P 500, basically we're down. The Dow Jones is down, the Nasdaq is down, the FTSE 100 is doing absolutely amazing, about over 5%. And when we look at the fear and greed, we're basically right now in greed mode. Now this means basically a lot of people are very bullish about stocks and so on. They probably will buy more now, and then of course that can easily change because at some point we were around here not long ago, so that could still happen. By the way, don't forget to join us on the Patreon account if you want to help the channel, inshallah, moving forward. And at the same time, if you can like the video, subscribe to the channel, that will be absolutely massive help. The first company we're going to talk about today is Mastercard Incorporated. This is one of the companies that I've had in my portfolio for a very long time. As you can see, a year to date is about 7% up. For the last 6 months is actually down, basically up 6%. And right now for this month is up about 4%, which is quite nice. So it's actually closer to the 52-week highs than actually the low, so which was about 428 in comparison to $588 per share, which is basically close where it is almost now. In my opinion, this is probably one of the best companies out there. As you can see here, it looks reasonably valued according to this. They have a small dividend of 0.5%. The very safe A+ credit rating, which is one of the highest. Qualified, well, we don't really care because we don't live in the US, but if you do, is the dividend taxation is the qualified. 512 billion market cap right now, so it's a mega cap. It's one of the biggest companies out there. The payout ratio for that dividend is very, very low, so it's basically about 19%, which is very nice to see. 15% latest increase, almost 15% for the last 5 years. Last 10 years, about 19% almost. So that dividend is growing very, very fast, which is nice to see. And the fact that it might be very low, this is why I don't really care too much on the actual the dividend yield side of things right now, but what I'm interested is the growth of that dividend. Okay, so for the last whatever years they have been growing it very nicely and very fast, which is basically all I want to see. And that's for 13 years of increasing that dividend. You get $3.04 for every share of this company that you own. And as you can see here, it's that basically that dotted line is inside within that line here, within that blue line, so that tells us it is reasonably valued right now according to the dividend theory method. Now if we look at these things, okay, earnings per share, payout ratio, sorry, it is been consistently staying where it is. Same goes for free cash flow payout ratio. Okay, look at this earnings per share, it's been growing amazingly every single year apart from 2020 COVID. Every year after that it's been going up every single year. So if you look at 2015, we had $3.43 to right now $16.40 expected in the next 12 months. Free cash flow per share is also heading in the right direction. Looking at shares outstanding, as you can see, shares are declining every single year because the company is buying back their own shares, which is quite nice. This is something that you really should be looking at when you're buying companies, because this is one of the ways companies return basically value to to shareholders, because what's happening is your share is now worth more because the company is buying back their own shares. The total sales, as you can see from here, basically has been growing every single year from just about below $10 billion to right now $29 billion, which is absolutely amazing. Return on equity and return on investor capital, you're not going to find many companies out there that has 188% return on equity, and basically when it comes to 52% when it comes to return on invested capital, operating margins of almost 60%, and free cash flow margins of almost 50% as well, which is absolutely amazing, and almost no debt when it comes to this company. Now, if we go back here and just look at this, some of the important parts, we're looking at current assets against current liabilities. So you can see the total current assets about, let's call it about $20 billion against total current liability. Total current liabilities of $17 billion. So they have more current assets than actually liabilities. Looking at total assets for this company, we're looking at about $48.4 billion against, let's see, total $41 billion. So that's absolutely covered, and there's nothing to worry about when it comes to that. Now, according to Wall Street, it is actually a buy right now. So if you can see 20 strong buys, 10 holds, and 1 sell. And as you can see here, it's about 10% upside from where we are. $616 per share is where they think the price should be moving forward. Earnings expectations for moving forward for this company, about 10%, 17%, another 17% for the next 3 years. There's a lot of analysts looking at this, which is quite good to see that. And then when you look at the revenue side of things, about 13%, 12%, another 12%. Again, another 20 plus people looking at this company. Now, when we look at the Morningstar valuation, you can see $289 per share. No, that is Visa. We need Mastercard, because we're going to look at Visa in a second. But the company that we're after right now is Mastercard. So we need Mastercard, not Visa. And as you can see, it's $500 per share, $563 per share is where they think the price should be. Refinitiv is actually saying $618 per share. Tip rank, more or less the same, I think it was. We will get strong by $635 per share. But if you are just looking at Morningstar valuation, is $500, so that's slightly higher than where we are. Now what we're going to do, we're going to use fast graph and to see where the company has been, and just give you a little bit of information about the company as well. So if we look at the overview for, if we look at the historical valuation for this company for Max, if we click Max here, as you can see, the orange line is basically the earnings of the company, and normally the price should basically track the earnings. And the blue line here is the basic normal PE, where Mr. Market likes to trade this company. And if for this line here is basically below the orange line, that's when undervaluation happens. If it's okay if it's basically between the orange line and the blue line. But you can see there's times where it's been below the orange line in 2020, and then 2010, 2009, and so on. But then after that, it's gone up and then it's come back down. But then since 2016-17 is basically been overvalued, even after COVID. That basically line here, that basically gray line, means basically sort of recession, or basically when the markets were down quite a lot. So that time it actually came back down, but it never actually gone below that orange line. And since then it's been overvalued, okay, over the last whatever years. If we reduce that, then that's basically earnings growth rate of about 23%. Fair valued about 23 multiples, and normal value is about normal PE ratio of 30. Now, if we look at it for the last 10 years, you can see 16 when it comes to the earnings, fair valued ratio about 16, 17, and normal PE for this company has been about 36 on the last 5 years, and you can see it's been always sort of overvalued. Now, if we look at the moving forward, so where does where's this going to go, this company, basically when it comes to earnings? Because this is the orange line, so this is what the company is expected to grow in the basically next couple of years. Now, if we use that normal estimate, so the basically we're using the earnings expectations about 15 and the fair value of 15, we are going to lose quite a bit of money for this company, about 17-18% basically per and total annualized rate of return. So basically you're losing about 18% of your money, and that is basically with the growth of expectation and about 17% in 2026 and about another 17% or basically in 2027. Now, if we use what normal multiples are for this company, and I think for that's for the last 5 years, okay, last physical years, you can see here they are expecting, so by the time we get to 2027, December 31st of 2027, we're expecting about 16%. So total annualized rate of return of 16%. That's if Mr. Market is right, and we are saying we're just going to follow that. Okay, so this is why I just need people to be careful buying basically these high quality businesses, especially when they trade in very high multiples. Okay, the other final thing I want to show you is if we go back to the summary and scroll down and just go to forecaster, for example, if we are using the estimate which I showed you early, you'll be losing about 17-18% per annum, right? With the growth rate of basically 15. If we use the 5-year normal PE, which I showed you early, you'll be making about 15%, 16% every single year. And again, that's the same sort of a growth rate. But then again, you're betting the markets will get it right and so on. Now, if that has happened, if we were in the normal estimate, the price for this company, okay, the future price will be 327. If we look at the 5-year normal multiples, we're expecting the price to hit about $828 per share. That's why you're making quite a bit of money. So it is interesting to look at those graphs and just basically use it for valuation, because it kind of gives you an idea where the company has been. So in a minute, I'm going to show you how many how many shares of this company I own in this portfolio, and actually I own it in both portfolios. So if you haven't joined us in the Patreon account, you can get access to that and see how many shares of Mastercard I do own and what my average prices and things like that are. Next one is Visa. So year to date is done up about 12%. Last 6 months are up about 13%, which is quite nice. And again, it's another one that's a bit expensive. Despite what the market has been doing, is actually closer to the 52-week range, high end, rather than the low end of $252 per share. Now, this is probably one of the best compounders out there with Mastercard, and as you can see here, it looks reasonably valued. Again, the dividends basically is less than 1%. You got 99% of safety, AA minus basically credit rating, very strong, 662 billion market cap, which is really good and huge company. Payout ratio, we're looking about 22%. The latest increase is about 14%. The 5-year growth rate of almost to 15%, over 15%, and the 10 years we're looking about almost 18%. Now, these two companies are very similar, very similar in a lot of things. 16 years of increase in that dividend, $2.36 is what you get for every share of this company. And as you can see, we're still within that blue line. So even if you look at stretch it out and look at the last 5 years, you can see there's times been where it was very much overvalued, and there was times where basically it was trading fairly valued, and then times where it's undervalued and so on. Now, if we look at everything else for this company, the payout ratio is very low. The free cash flow payout ratio is also low. The earnings per share, as you can see here, has been growing absolutely massively from $2.62 in 2015 to right now over $12 per share. And free cash flow per share has been growing as well. Now, shares outstanding has been declining. Total sales has been going in the right direction. Return on equity 51%, return on invested capital 31%, operating margin 67%, and free cash flow margin of 58%. Love these companies. Very low debt. Absolutely nothing to worry about when it comes to debt levels. And this is why it's important to buy this type of businesses when they are very much cheap, and then hold them for a very long time. That's at least what I've tried to do here. Okay, the total current assets, we're looking at about $32 billion against the total current liabilities of $30 billion. So we've got enough to cover that. And basically the total assets for this company, okay, we're looking at about let's call it about $93 billion against basically let's call it $55 billion of total liability. So nothing to worry about in terms of that. Now, looking at ratings for this company, as you can see, it's a buy, 22 strong buys, 11 buys, 7 holds, and 1 sell. And that means about 7% upside from where we are. $377 per share is where they think the price should be, according to Morningstar as well. If we look at the analyst here and we start with Refinitiv ratings, for example, you can see 7% upside from where we are. 370 let's call it $380 per share. Tip rank, let's see what they say. Strong buy and $385 per share. That's about 8% upside from where we are. And Morningstar is saying basically, let's call it 290, and that is way higher than where it should be. So that's the reason why it's 2 stars right now. Again, you have to do what you need to do, but you have to always be careful. Okay, now looking at this, basically it's the max again. We're looking basically about an earnings expected basically growth rate of 20% for the last basically since 2008, and the fair value for this company has been about 20. The normal P has been about 27, and as you can see, there's times where that basically the price which is that black line here. Okay, that line was basically around the same as the orange and between the orange and the blue, but right now, since basically 2020, just like Mastercard, basically it's been heading the upwards every single year, and that's why it seems very much overvalued right now. If we reduce that, you look at the last 10 years, exactly the same. And as you can see, this line here, this gold line, that's basically the dividend the company has been paying. And if we reduce that, you can see every single year the dividend has been basically going up and up every single year. Now, if we look at the forecast moving forward for this company, and we are using that 15 PE, we will be losing about almost 18%, which is very interesting. It's similar to Mastercard, right? But if we use the normal PE, what most of the market likes to trade this company, okay, and that is about the 30, we are making about 10% per annum, or let's call it about almost 11% total. You've got about 11%. So it is interesting how similar these two companies are, but it is important to buy them when they are very much undervalued. And if we look at the summary, for example, and you go to this thing here, and like I was showing you earlier, if we see the 5-year normal multiples, we're expecting the price to be about $447 per share, basically in the future, in the next couple of years. So it is interesting to see. And as you can see here, both companies have been beating the S&P 500. So this here, the SPY is the S&P 500. This is Visa. And as you can see, for the last 20 years, basically, we've got annualized return of 21% for the company and about 10% for the S&P 500. Mastercard is more or less exactly the same. If we go back here, and you will see that they've done similar sort of returns, 29%, 24%, 20%, and so on. So they are both high quality businesses, but the issue is they seem very much overvalued right now. I've got Visa here. I wish I bought more. I'd only own 20 shares. And as you can see, basically right now is about $231 pounds invested, up about over just the 50%, and on 20 shares, my average price $221 per share, or 170. So I'm not buying this. I'm not basically buying this anytime soon. If it goes below, I've always said I wanted to buy this when it was below 200, and I waited and waited for a very long time. So I'm just going to leave it alone. I'm not adding to it anytime soon. If it comes back down, I don't know, maybe below 300, 250-ish, maybe I might have a look at it. But right now, I'm just going to leave it alone. So that is Visa. And Mastercard here, also another 12-13% upside from where basically gains, if you like. And I do own 12 shares of this company. $468 per share is basically my average, and as you can see right now is $563 per share. So like I said, I've owned 12 shares of that company. So that's the two companies I wanted to share with you guys. I hope you enjoying this type of content. It takes a lot of time and effort to put these things together, and also a lot of the websites that I use, including this one here, including the Fast Track and so on, and basically all of them are subscription based. So if you can join us to Patreon account, you get access to the family portfolio, all the buys and sales that I'm making regularly. I'm kind of basically doing as much as I can, the monthly and the valued stocks and so on. And of course, you get all of these things out there, and by just paying £4 something, whatever it is, and that will help the channel if you can. Anyway, I'm going to stop the video here. Have a wonderful day. Assalamu Alaikum.